Good morning everyone and welcome back to Morning Markets. This is our first update since the Easter long weekend. Today we're going to be covering US jobs growth and what it means for markets. So the UK and Europe were largely closed, but what you'll see on screen was that we saw a positive impact on US and global equities over the weekend. We also saw a rise in bond yields, that is, that bond prices fell, reacting to the non-farm payrolls print for the month of March, which came out on Friday. Now, there was little surprise in the data, which is encouraging. The headline print was 236,000 jobs created in the US economy for March. However, there were other numbers published along with that, which show that the US economy continues to slow back to something more normal. So, for instance, the wages data continues to cool, and wages in the US are now growing at around about 4.2%. Now, that's very much in line with a long-term inflation target of around about 2%. But more importantly, the data is continuing to trend down and slow. And that's largely because there are more people now in the US of working age who are looking to enter the jobs market. And that's cooling the pressures on wages and also on the demand for labour. So you'll recall that over the previous 6 months, we've spoken to you largely about how employers were unable to match skills to workers. Well, now what we're seeing is that with higher wages on offer, there are more people wanting to enter the workforce. And that's really dampening down the inflation effect that we're seeing through the wages data. And this is encouraging, and this will likely be a big factor which feeds into the Fed's considerations when they meet at the end of this month for the May meeting for the FOMC. The markets have reacted quickly to the strong jobs data. In fact, we're now expecting that there is a high likelihood that the Fed will raise rates by another 25 basis points in May should they wish. However, there will be other considerations, other inflation prints through this month, which they'll likely consider. And they'll also look for some other survey data to try and assess any impact from the banking fallout from the month of March. The jobs print was the data was collected before the SVB banking crisis in the US, so it's unlikely to reflect any tensions within the financial services sector with regards to jobs. So we'll have to wait for over the next couple of months to see if there's any further weakness in jobs, particularly in the banking sector, for it to come through. So the Fed have a lot to think about, but it's likely, as markets have priced, that they will be guided towards another 25 basis point hike in May. However, we will look at the inflation data which comes out on Wednesday to see whether the broader economy is still experiencing the inflation pressures that have been in place for the last 12 months or so. But please do join us tomorrow where we'll update you on events in the UK in particular. Thank you.